Welcome to the TAC Index AI podcast, February 12, 2026, where we blend TAC IP data, reports, and charts with the latest news in all things logistics with a focus on air cargo.
It's interesting. If you just glanced at the global numbers this week, you'd probably think the air cargo market is, well, hitting the snooze button.
I thought the same thing. The main index, the Baltic Air Freight Index, the BAI0, it's barely moved at all, down just 0.5%.
And basically flat compared to last year. It has all the signs of that typical post-Chinese New Year slowdown.
But that flatness is deceptive, isn't it? It feels like it's masking something.
It's a total statistical mirage. It's hiding this massive divergence that's happening between East and West.
Okay, so let's dig into that. Where's the strength?
Well, if you're moving goods out of Shanghai, you're definitely not seeing any kind of slowdown. That index, the BAI80, is actually up almost 20% year on year.
Wow, 19.4%. That's a huge number. And Hong Kong is also bucking the trend, right? I saw it actually climbed a bit this week.
It did, up 1.6%. But that's very specific. It's really being driven by demand into North America.
So not a broad-based surge.
Not at all. And here's where it gets really nuanced for anyone trying to plan their routes. The China alternative markets are all splitting.
What do you mean by splitting?
We're seeing rates from Vietnam to the U.S. going up, while rates from Vietnam to Europe are falling.
And it's the reverse for other hubs.
The exact opposite for Seoul and Taiwan. For them, rates are rising to Europe, but falling to the U.S. It's like a game of logistical musical chairs.
So shippers are clearly reshuffling things based on very specific needs. It's not one big Asia boom.
Precisely. Now, while Asia is, let's say, complicated, the Western export hubs are just painful.
Painful is definitely the right word for Chicago. I saw that BAI 50 data. It fell another 8% this week alone.
It is an absolute free fall. Chicago is now sitting at negative 33.5% compared to last year.
And what's dragging it down so much?
It's mainly the collapse in rates going to Southeast Asia. And Europe isn't doing much better. Frankfurt's BAI 20 dropped almost 4%.
And year on year, Frankfurt is down 20%. London also dipped.
Exactly. So you have this completely bifurcated reality. If you're a carrier, Asia outbound is where you're making your money.
But if you're a shipper out of the U.S. or Europe, it's a buyer's market. But, and there's always a but, are those low rates about to get wiped out by rising fuel costs?
That is the million-dollar question.
Yeah.
And the risk is real. We have to look at the energy markets. Brent crude just popped back over $70 a barrel.
That seems counterintuitive. Didn't the U.S. just report a massive build in crude inventory? Usually that supply would push prices down.
Normally, yes. An 8.5 million barrel build is significant, but the market is completely ignoring supply right now.
So it's about sentiment.
It's all about the fear premium. With U.S.-Iran tensions flaring up, traders are pricing in the risk of a future conflict, not the reality of current inventory.
And that fear premium, for anyone listening, eventually shows up as a higher fuel surcharge on your invoice.
Sooner or later, it always does. So even if your base rate out of Chicago is falling, your all-in cost might not move nearly as much as you'd hope.
You get squeezed between soft demand and hard costs. And looking at the bigger picture, the macro environment isn't really helping, is it?
Not at all. Did you see that Reuters report on the EU's new strategy? They're calling it de-risking.
This is the push to reduce dependency on the U.S. and China.
That's the one. They're talking about all these bureaucratic hurdles and non-tariff barriers that act like, well, an invisible tariff. They estimate it's like a 44% tax on manufactured goods.
44%. That's staggering. We fixate on a 10 or 20% tariff, but that level of friction from red tape just changes the entire calculation for a supply chain.
It absolutely does. It forces you to shorten those supply chains almost regardless of the freight rate. And then over in the U.S., the CBO is forecasting deficits to hit nearly 6% of GDP.
Which means the government will be looking for revenue, and tariffs are always an easy target.
So you have this potential pincer movement. The EU building walls for autonomy, the U.S. raising tariffs for revenue. The whole era of frictionless global trade feels like it's being put on pause.
It's a sobering thought. So to wrap this up, what's the key takeaway for this week?
I think it's don't trust the global average. You have to get granular.
So you have leverage if you're shipping out of the West, but you've got to watch those fuel surcharges like a hawk.
Exactly. And if you're booking anything out of Asia, especially Shanghai, you should still expect to pay a premium for a while longer. The power is still with the carriers there.
And the wild card remains whether those rising oil prices from Middle East tensions will eat into everyone's margins just as the post-holiday volumes really soften.
That's what we'll be watching.
Until next time.